You check the price of gold this morning and it's sitting at $4,400 per ounce. You think to yourself, that's high, maybe I should wait for a pullback before buying. But here's what you're not seeing. This isn't a peak. This is a consolidation before the most violent move higher in precious metals since March 2020 when COVID shut down the world and gold ripped from 1,500 to 2,000 in 8 weeks. Except this time, the catalyst isn't a virus. It's something far more dangerous. It's the moment every central bank on Earth realized that holding US Treasury bonds might be a political decision, not just a financial one. And that realization started on January 3, 2025, when US military forces flew into Venezuela, extracted a sitting head of state, and brought him to a detention center in Brooklyn. You want to know why gold's going to 5,000? That's why. Because when one sovereign government can reach into another country and physically remove its leader, every reserve manager in Beijing, Riyadh, Moscow, and New Delhi asks the same question: could my treasury holdings be frozen next? And once that question gets asked, it doesn't get unasked. My name is Alex, and for the last decade I've been tracking capital flows that most people never see. The stuff that happens in central bank vaults and sovereign wealth fund allocation meetings, the decisions that move billions before they ever hit a headline. And what I'm watching right now in the gold market isn't speculation, it's structural. If you're trying to understand why gold rallied 65% in 2025, why it's the strongest year for gold since 1979, or why every traditional model said it should be falling while the dollar stayed strong and interest rates stayed elevated, make sure to hit that subscribe button because this channel breaks down the market moves that Wall Street explains after the fact but never sees coming in real time. Here's what we're looking at. Gold started 2025 at $2,600 per ounce. By late December, it had broken $4,300. That's a 65% move in 12 months. For context, the average annual return for gold over the last 50 years is around 7%. This wasn't a normal year. This was a repricing event. And the Maduro extraction on January 3rd wasn't the cause, it was the accelerant. The conditions were already set. Central banks had been buying over 100,000 tons of gold per year for 3 straight years, 2022 through 2024. That's not portfolio rebalancing. That's a strategic shift. The World Gold Council's 2025 survey showed the strongest intention to continue buying gold since the survey began in 2019. And here's the part that should make your ears perk up. 59% of central banks now report holding their reserves domestically instead of traditional custody locations like the New York Fed or the Bank of England. Think about what that means. For 70 years, the standard was to hold your gold in New York or London because those were considered the safest, most liquid markets. Now, central banks are pulling physical metal back home. That's not a technical decision. That's a trust decision. But here's the thing. The mainstream narrative around gold in 2025 completely missed this. Every strategist on CNBC in January was calling for gold to pull back because the Fed was keeping rates elevated, the dollar index was holding above 100, and inflation was moderating. In their model, gold shouldn't rally in that environment. Gold is supposed to go up when rates are low, when the dollar is weak, when inflation is spiking. But that model is 20 years out of date. It assumes gold is primarily a hedge against US consumer price inflation. It's not anymore. Gold today is a hedge against geopolitical instability and monetary system fragility, and 2025 delivered both in spades. So let's walk through exactly what happened, because the setup for $5,000 per ounce isn't some wild speculation, it's already in motion, and understanding the mechanics of how we got here will show you why the next leg up is almost inevitable. What I'm about to show you next is the thing that took me years to figure out, and it's the reason I went from thinking gold was a boomer relic to realizing it's the most important asset class for the next decade. The first thing you need to understand is the ComEx delivery mechanism, because this is where the paper market meets physical reality, and the gap between those two things is widening fast. The ComEx is the commodities exchange where gold futures contracts are traded. Most of those contracts are cash settled, meaning nobody actually takes delivery of physical gold, they just trade the price movement. Historically, less than 1% of open interest in gold futures resulted in physical delivery. That was the norm for decades. But something changed after 2020. In December 2025, the ComEx saw 37,003 contracts delivered. Each contract represents 100 ounces of gold, so that's 115.1 tons of physical metal delivered in a single month. The delivery rate hit 6.8% of open interest. That's nearly 7 times the historical baseline. And this isn't a one-month anomaly. Delivery rates have been elevated since the COVID crisis, but December 2025 was the highest monthly delivery in the history of the exchange outside of the March 2020 chaos. Now here's where it gets interesting. While delivery rates are spiking, the amount of gold sitting in ComEx registered warehouses, the metal that's actually available for delivery, has been dropping. In March 2025, registered inventory peaked at 13.5 million ounces. By the end of December, it had fallen to 10.1 million ounces. That's a 25% drop in deliverable supply while delivery demand hit records. You don't need a PhD in economics to see the problem. When more people want physical metal and there's less metal available to deliver, something has to give. Either the price goes up or the exchange changes the rules. And before you think they'd never change the rules, go look up what happened to nickel futures on the London Metal Exchange in March 2022 when a short squeeze nearly collapsed the market. They literally canceled trades. The paper market works until it doesn't. And here's the part that should terrify anyone holding paper gold exposure without physical backing. Look at who's taking delivery. In December 2025, Wells Fargo's proprietary trading desk took delivery of 42,900 ounces in a single settlement. Morgan Stanley accumulated 44,000 ounces in parallel. These aren't retail buyers. These are institutional desks positioning for a scenario where the paper-to-physical spread blows out. When the big banks are pulling metal out of the exchange, that's not a bullish signal for paper contracts. That's a warning that the people with the best information think physical is going to trade at a premium. But the ComEx story is only half of the equation. The other half is what's happening in the ETF market, and this is where you can see the institutional money shift happening in real time. Global gold ETF inflows hit $57.1 billion in 2025, pushing total assets under management toward $445 billion. US-listed funds alone attracted $32.7 billion. To put that in perspective, that's more inflows than the previous 3 years combined. And the flows weren't steady, they were concentrated in specific moments of geopolitical stress. SPDR Gold Shares, ticker GLD, the largest physically backed gold ETF in the world, logged its biggest single-day inflow ever in September 2025, $2.2 billion in one day. The three biggest daily inflows in the fund's 21-year history all happened in 2025. This isn't retail panic buying. Retail doesn't move $2 billion in a day. This is pension funds, endowments, and sovereign wealth funds rebalancing allocation targets from 2 to 3% gold exposure up to 5 to 7%. And that rebalancing process takes quarters to complete. It's not done. Now, I know what you're thinking. If institutions are buying and central banks are buying, why did gold pull back from 4,500 to 4,400 in late December? Great question. And the answer tells you everything about what's coming next. The pullback wasn't driven by selling, it was driven by profit-taking from momentum traders and year-end rebalancing from funds that had outsized gains and needed to lock them in for performance reporting. Look at the volume during the pullback. It was thin. There was no panic, no capitulation, just mechanical selling into a market that absorbed it without breaking support at 4,200. That's a healthy consolidation in a bull market, not a reversal. And the fact that it held 4,200 while the dollar stayed strong and the Fed kept talking about higher for longer rates tells you the bid underneath this market is structural, not speculative. We're halfway through, and if you're still with me, you're already ahead of 90% of people who looked at gold in 2025 and thought it was overpriced. But don't stop now, because the next part is where we connect the Maduro extraction to the Fed meeting on January 27th and 28th, and show you why those two events together create a compression window that could send gold vertical. Let's talk about what happened on January 3rd, 2025. U.S. military forces, working with opposition groups inside Venezuela, conducted an operation to extract Nicolas Maduro from Caracas. He was flown to the United States and is currently being held in a detention facility in Brooklyn, awaiting trial on narcotics trafficking and corruption charges. The operation was clean, fast, and unprecedented. Love it or hate it from a geopolitical standpoint, the signal it sent to every other sovereign government on Earth was unmistakable. The United States is willing to reach into another country and physically remove its head of state. Now, most people looked at that story and thought about oil, about Venezuelan reserves, about what it means for the region. And yes, Hungary's Viktor Orbán called Venezuelan oil reserves good news for Europe after the extraction, which tells you energy markets were watching. But the real story isn't about oil, it's about trust. Because here's the thing. If you're a central bank reserve manager in Saudi Arabia or China or Russia, and you're sitting on hundreds of billions of dollars in US Treasury bonds, and you just watched the US government fly into another country and take its president, you start asking uncomfortable questions. Could my Treasury holdings be frozen if we have a political disagreement? Could my assets be seized? The US has already frozen Russian central bank reserves, $300 billion worth, after the Ukraine invasion in 2022. That was a watershed moment, but it was framed as a wartime exception. The Maduro extraction is different. It's peacetime, it's proactive, and it shows a willingness to use financial and military tools in ways that make every other country wonder if they're next. And this is where the gold buying makes perfect sense. Gold can't be frozen. It can't be seized unless someone physically takes it, and if you're holding it domestically, that's not happening. Gold is the only reserve asset that has no counterparty risk. When you own a treasury bond, you're trusting the US government to pay you back. When you own gold, you own the metal. There's no middleman. And after January 3rd, that distinction matters more than ever. The 59% of central banks now holding reserves domestically instead of New York or London isn't a coincidence. It's a response to a world where financial assets can be weaponized. Now let's connect this to the Fed meeting at the end of January. On December 18, 2024, the Federal Reserve announced it would resume purchasing $40 billion per month in US Treasury securities starting in January. This wasn't QE in the traditional sense. It was framed as technical support for Treasury market functioning after liquidity issues in the repo market showed stress. But here's what markets heard. The Fed is back to buying bonds. And when the Fed buys bonds, it expands its balance sheet, which is effectively monetary expansion, which is traditionally bullish for gold. The January 27th to 28th meeting is expected to validate the rate cut narrative that markets have been pricing in for months. Futures markets are pricing in a 78% probability of at least one rate cut by mid-2025. If the Fed signals that cuts are coming, that validates the idea that rates have peaked, and gold historically rallies when the rate hike cycle ends. So you've got two forces converging. You've got a geopolitical event, the Maduro Extraction, that fundamentally undermines trust in the reserve currency system. And you've got a monetary policy shift, the Fed pivoting from tightening to easing, that removes the main headwind gold faced in 2023 and 2024. Those two forces together create the setup for a melt-up. Because the central banks that are already buying gold, they're not going to stop. The institutions that are rebalancing into 5 to 7% allocations, they're not done. And the momentum traders who sold at 4,500, they're going to chase back in when it breaks that level again. That's how you get to 5,000. But here's where the psychology matters. And this is the part most people don't talk about. Gold isn't just a financial asset, it's a confidence barometer. When gold is going up, it means people are losing confidence in something else. In 2020, gold went up because people lost confidence that governments could handle COVID without printing money. In 2025, gold went up because people are losing confidence that the reserve currency system is as stable as it was. And once confidence starts to erode, it doesn't come back quickly. Trust takes years to build and seconds to lose. The Maduro extraction was one of those seconds. Now let me address the skeptics, because I know there are people watching this thinking, Alex, this sounds like doomsday fearmongering. Gold bugs have been calling for the collapse of the dollar for 50 years, and it hasn't happened. Fair point. But here's the distinction. I'm not calling for the dollar to collapse. The dollar is still the reserve currency. It's still the most liquid, most trusted currency in the world. But trusted by whom? That's the question. If you're a US citizen, you trust the dollar because it's your currency. But if you're a central bank in a country that might find itself on the wrong side of US foreign policy, your calculation is different. You're diversifying, not abandoning. And diversification at the central bank level means buying gold. That's not speculation, that's what's already happening. The 1,000 tons per year of central bank buying for 3 straight years proves it. The World Gold Council survey showing the strongest intention to continue buying proves it. The 59% domestic custody proves it. The data is already here. And here's the other thing. Even if you think the dollar is fine and the reserve system is stable, gold still makes sense as a portfolio allocation because it's outperforming everything else. In Q3 2025, gold outperformed every major asset class by an average of 35%. It beat the S&P, it beat bonds, it beat real estate, it beat commodities, it beat crypto. If you're a fiduciary managing money for retirees or endowments, you can't ignore that performance. You have to allocate to it. And when you have trillions of dollars in institutional capital deciding they need 5 to 7% gold exposure instead of 2 to 3%, that's hundreds of billions of dollars of buying pressure that hasn't even started yet. Now let's talk about the mining equities, because this is where the leverage is. Newmont Mining, the largest gold miner in the world, returned 160% in 2025. Barrick Gold returned 181%. Those returns are multiples of the gold price move because miners have operating leverage. When gold goes up 10%, mining company profits can go up 30 or 40% because their costs are relatively fixed. And here's the thing. Most mining stocks are still trading at valuations that assume gold is going back to $3,000. If gold goes to $5,000 and stays there, mining equities could double again from here. I'm not saying you should go all in on mining stocks. They're volatile and they come with operational risk and geopolitical risk. But if you believe gold is going higher, the miners are how you get leveraged exposure. Now, some of you are holding physical gold, coins or bars in a safe or a vault, and you're wondering if you should sell into this rally and take profits. Here's my take. If you're holding physical gold as insurance, as a hedge against systemic risk, you don't sell it just because the price went up. That's like selling your homeowner's insurance because your house hasn't burned down. The point of holding physical gold is to have it when you need it, and you won't know you need it until it's too late to buy it. The premium on physical gold over spot price, the amount you pay above the ComEx price to actually get coins or bars delivered, has been widening. In 2020, during the COVID panic, premiums hit 10 to 15% over spot. Right now, they're running 3 to 5%, which is elevated but not panic levels yet. But if we get another geopolitical shock, another bank failure, another freeze of sovereign assets, those premiums could spike again. And when that happens, paper gold and physical gold become two different assets trading at two different prices. That's called backwardation, and it's already starting to show up in futures markets where near-term contracts trade at a premium to longer-dated contracts, which is the opposite of how it's supposed to work. Let me tie all of this together, because when you see how these pieces connect, the picture becomes clear. You've got central banks buying over 1,000 tons per year and holding it domestically because they don't trust the custody system. You've got institutions rebalancing into higher gold allocations because the performance demands it. You've got ComEx delivery rates at 7 times historical norms, while registered inventory drops 25%. You've got the Fed pivoting from tightening to easing with rate cuts likely by mid-2025 and $40 billion per month in treasury purchases. You've got a geopolitical landscape where sovereign assets can be frozen and heads of state can be extracted, which fundamentally changes the risk calculation for every reserve manager on Earth. And you've got gold futures trading in backwardation, physical premiums elevated, and Bank of America putting out a $5,000 price target. That's not one data point. That's a confluence of structural forces all pointing in the same direction. We're in the home stretch now, and I need to show you what happens next, because the compression window I'm talking about isn't theoretical, it's happening right now. The January 27th to 28th Fed meeting is the catalyst everyone's watching. If the Fed validates the rate cut narrative, gold likely breaks 4,500 within days. If they sound more hawkish than expected and push back on rate cut expectations, you'll get another dip, probably back to 4,200, which becomes the highest conviction buying opportunity of the year. Either way, the path to 5,000 is open. The only question is timing. And here's the thing that keeps me up at night. The gap between paper claims and physical metal is widening. There are far more people who think they own gold through ETFs, futures, and unallocated accounts than there is physical gold to back those claims. This works fine as long as nobody asks for delivery. But the moment you get a rush of delivery requests, the whole structure comes under stress, and we're already seeing the early signs. The ComEx data shows it. The elevated premiums show it. The central bank repatriation shows it. When Wells Fargo and Morgan Stanley are pulling metal out of the exchange, that's not random. They see something coming. So here's what you need to know. If you're holding physical gold, you're positioned correctly. The volatility is uncomfortable, but the trend is your friend. If you're trading futures around the Fed meeting, your risk is that you're playing a paper market that might decouple from physical reality. If you're positioning through mining equities, you've got leverage to the upside, but you also have to stomach the operational risk and the fact that miners can underperform if costs rise faster than revenue. And if you haven't allocated to gold at all because you think it's too late, You're making the same mistake people made when it broke 3,000, when it broke 3,500, and when it broke 4,000. This isn't a top. This is a repricing of what hard assets are worth in a world where financial assets can be frozen, and monetary policy is trapped between inflation and recession. The boulder isn't on your shoulders anymore, it's rolling downhill. For 70 years, the global financial system ran on the assumption that US Treasury bonds were the safest asset in the world, and the dollar was the unquestioned reserve currency. That assumption is cracking. Not breaking, but cracking. And gold is the asset that benefits when those cracks widen. You're watching the transition happen in real time. The central banks see it. The institutions see it. The big banks see it. The only question is whether you see it before gold is at 6,000, and everyone's talking about how obvious it was. Gold's breaking 5,000 because the world changed on January 3rd, 2025, and once the world changes, it doesn't change back. What financial topic is affecting your life right now that you can't find a straight answer on? What do you want me to dig into next? Let me know in the comments because that's what this channel is for, cutting through the noise and showing you what actually matters before the headlines catch up. Your future self, the one who positioned correctly before the crowd, is counting on the decisions you make right now. The math is in front of you. The data is in front of you. The opportunity is in front of you. The only question left is whether you're standing in front of the boulder or behind it.